Welcome to the Real Advisor Podcast. TRAP, TRAP. Please follow us and join in the conversation on Twitter @Advisor Podcast, where you can suggest ideas and themes you'd like the TRAP team to discuss. Also remember to like and subscribe to our YouTube channel and leave a 6 out of 5-star review on iTunes. Doing all this really helps us, which means we can do more to help you. Now let's head over to the studio for the latest pile of TRAP.
Yes, indeed, dear Trappists. Welcome back to what many people are calling episode 53 of the Real Advisor Podcast, TRAP, TRAP. My name is Lick Lincoln. Joining me, as ever, in the digital studio of doom are the three other horsemen of the apocalypse. Carl Della Voce Widger, in a bunker somewhere in deepest Dublin. Andy Ultra Heart and Alan the Storyteller Smith. Now, gentlemen, we have a show packed full of absolutely nothing. So let's start unpacking it straight away with one or more high-energy review reads read out by my very good friend, the Right Honourable Mr. Andrew Hart.
Thank you very much, boss. First review is from Gunny Goo, entitled Interesting, 5 stars, interesting podcast, seemingly decent guys that clearly care about client outcomes in a constantly changing environment. The next review is from Raging Horn via Apple Podcast, but his real name will be revealed in a second. It's a glowing review, a lifeline for financial planners, 5 stars in the title, but it starts off with 6 stars. I missed them for 2 weeks. I'm honestly a little bit sad after finishing an episode because I know I've got to wait 2 weeks before I get my top up. Listening to Trap Podcast every fortnight has been a game changer for me. They just get it and articulate all the thoughts swirling around in my head. Their insights make me feel understood and less lonely in this challenging profession. Trap is more than a podcast. It's a companion that keeps me grounded and motivated. Thank you for making a difference, keeping me company on my dog walks or while I drive to client meetings. The links you share are awesome. Never stop being you. 6 stars all the way. Pete, solo advisor with a bloody awesome support team. So Raging Horn is also known as Pete, solo advisor. Back to you, Nick.
Wow, Pete the Raging Horn. That is what a lovely thing to say. And we really do appreciate the reviews. So please do keep them coming in. Leave your reviews on iTunes. You can also now rate on Pocket Cast. I think Pocket Cast takes in iTunes reviews. I'm not sure it gives back. I'd be very much surprised. But anyway, if you can rate wherever you can, it gives us a bit more energy and a bit more motivation to keep on plodding through. 53. Jesus, how did we get here? Okay, topical tidbits. Let's put a timestamp on this episode. By the way, just to say, dear Trappists, if you're listening to us or watching us and we're sounding slightly fatigued, 3 of us, not Wodge, not the voice, but the other 3 members of the Trap Pack, we had lunch yesterday with well, I guess we could now say he truly is a close personal friend and a big fan of the show, Rory Sutherland, who is, of course, the advertising stroke sort of branding behavioural guru, written some great books, a great speaker, and we had a great lunch with him at the Devonshire in London. Soho, Soho, on the cusp of Soho. I'm sort of going further west. Really good time, but it was quite hard work. And the whole point was we were then going to go and watch Rory doing a live podcast recording at a club that some of us frequent, all of us actually frequented. Homegrown.
We made it. We made it.
We made it to the club.
We made
about
it to
2
the
minutes.
gig.
We'd had Rory for 2 hours over lunch.
And he was regurgitating the same stories that he shared with us at lunch. We had 2 hours of him live at lunch, and then we thought, well, we've heard it all now, so we were going to bugger off to the bar. So that's what we did.
It was good fun. It was good fun.
And then slightly tired, shall we say, today. It was what you call a long lunch.
Long lunch, yeah. If you can get a table at the Devonshire, we were very lucky because we booked at 3 p.m. on a Tuesday, basically a quiet time of the week. But it's booked out months and months in advance. So do check it out. The Devonshire.
Actually, it was 3:15, wasn't it? It was 3:15. Is that Trappist? You decide. 3:15. Is that a late lunch or an early dinner? Let us know.
Early dinner. I'm saying early dinner.
I'm saying late lunch. I'm going late lunch.
What are they famous for recently? The first pub that's got Guinness Zero.
Guinness Zero, on draft. Yeah,
on draft.
Not that we tasted anyway.
That didn't bother us.
But
and at 8 o'clock this morning, I was doing I was a podcast guest on gorgeous George Barboff's podcast, and I played 2 hours of doubles tennis. So I am literally just fading away to talk. So let's crack on with this.
You're a hero, Nick. You're a hero.
I am a hero. I am a hero to myself and to many people out there. Storyteller, DFA movie premiere.
I don't know if you saw this. A few guys have even seen the film. Dimensional Fund Advisors have created a film. They've hired, can't remember his name right now, but he is a top kind of Hollywood producer of quite a few famous films and TV shows. And they've created a movie called Tune Out the Noise. First of all, any of you guys seen it? You watched it yet? No,
they've done a couple of sort of premieres of it, haven't they? But I've not been available when they've been on.
Yeah, there was lots of issues around copyright or something, streaming rights or whatever. So it's not generally available. But they are they're having movie nights premieres in the UK, starting in London on the 22nd of October. Then going all the way through Bristol, Birmingham, Manchester, Nottingham, and up to Edinburgh by the 19th of November. So they're having all that, renting out a private cinema, inviting people along. It's worth seeing. It's no blockbuster or latest sort of movie rom-com smash, but it's interesting when they sort of go through the entire story of the company from, as we know, from David Booth starting it in his apartment in Brooklyn. It's worth seeing. So if you work with Dimensional, reach out to your point of contact and ask to be invited along. And if you don't, you may also wish to reach out and just get a little bit of the backdrop and the story about the organization and the company. Worth seeing.
Okay. And we'll be coming back to Dimensional and Dr. Eugene Farmer in the meat and potatoes later on, dear Trappists. Okay, this is more of a housekeeping issue that maybe I should have brought up before we hit the record button. I think we're getting a bit late for this Tough Mudder thing, aren't we? If we're going to do it, maybe do it next year and all 4 of us do it. Or not do it at all. Carl, you're never going to do it.
I think Alan
I'll be the non-playing captain. I told you that before.
Oh,
yeah.
You've done a marathon.
I think it's
half marathon. And
when is it again, Nick?
20th of September. Is it Surrey area? I don't quite know.
That's like next. That's racing up.
That's quite soon. Maybe we should.
If we do it, we won't do it properly. So I think we can and we'll do it properly if we do it at all. And we'll get some trap swag that we can wear and we can give away to people that enter as Team Trap, perhaps. But so Tough Mudder for 2024. Calling it here, not happening. But Vanguard, crack on without us. It won't be the same, I know, but you can do it. You can do it. All right, we're reaching.
But we'll be there in 2025 for sure.
Okay, cool.
Right,
voice. Dear. Elkstone and Shuttle, which sounds like a third-rate Channel 4 comedy act.
Yeah, I just thought I'd bring this up. So Shuttle have been given their authorization by the Central Bank of Ireland. Shuttle are, it seems, from what I can find out about them, a private equity platform for retail investors. So you can get in for kind of very small money on the back of some private equity deals. And then Elkstone would be pretty well known here in Ireland as kind of startup backers, that kind of stuff, amongst other things. And they're out in the news recently saying that they want pension funds to be able to invest in startups. So, look, on the one hand, there's a... on the one hand, it is good to see innovation and it is good to see choice out there. But on the other hand, I'm just not sure should retail investors for kind of small money be jumping in on PE deals that they might not understand. And why would we want to allow pension funds? See, there's auto-enrollment coming into Ireland. It's supposed to be, I think, the beginning of next year, but it's going to be delayed. But anyway, that's why everyone is jumping on, well, can we let pension funds invest in this kind of stuff? I don't think it's a good idea. But back to point number one, it is nice to see that there is some kind of innovation in the Irish market, which will only beef up competition, and that can only be a good thing. So I just thought I'd mention them because, things are beginning to happen in this market, thankfully. Competition is good.
What is, though, intrinsically wrong with about 4% above inflation in the public markets on average over 100 years. What is wrong with it? What are we trying to do here by investing in startups?
And that is the point, Alan. 100%, that is the point. And we will be talking about that, I think, in the meat and potatoes a little bit later on. But look, there is always. I know that you guys have had the BISA debate over there. And it's kind of something similar. It's like, the Elkstone argument is we should be backing Irish startups, and this is a good idea and whatever. But look, should retail pension investors be investing in this stuff? My call is absolutely not. But hey, up to Elkstone and everybody else to make their point and make it. But please do it, in an evidence-based manner, which we will talk about later on. But yeah, 100% agree, Alan.
All right.
Cool. Okay, Ultra, Howard Marks.
Okay, so Howard Marks is an American investor, and he produces quite a lot of content. He's famous for writing memos. I don't know if any of you guys have dabbled in these memos over the years, but
I find them dull. Very dull.
You find them dull. Okay, some of them are good, some of them are bad. Do a search, Oak Tree Capital memos from Howard Marks. He's also got a podcast where they read out the memos. Some better than others. Take it with a pinch of salt, but it's free information out there. But he's a very, very experienced investor stroke sort of hedge fund manager. So he's coming from a point of authority. Not mentioned it before. I don't think anyone else has. So yeah, Oak Tree Capital, oaktreecapital.com/insights, memos from Howard Marks. Back to you.
Right, to keeping the excitement level bubbling at a feverish pitch, Storyteller Protection Review.
Just noticed this in the press recently. But it leads to other issues. So our regulator, the FCA, have announced they're going to undertake what I think is the first ever, certainly in their tenure, complete overhaul review of the protection market in the UK. It hasn't really been explored exactly what they're going to be reviewing, but it's going to be a detailed, comprehensive review, I guess, of how products are created, how they are sold, how they are paid for, all that sort of thing. So detailed review is going to be underway this year. But that just led me to think further about the protection business and protection market in general, because I don't know, sometimes I get a little concerned because we as a business do very little. I mean, very little protection.
Yeah.
And I hear this, most of the advisors that I speak to say the same thing. When I started 20 years ago, you would be recommending insurance policies, protection, critical illness, all that sort of thing, private medical potentially. But it's very rare nowadays. And, why is that? Why do we not? I mean, what about you guys? Are you active in the protection market?
Yeah, I think though, Alan, to be fair, that comes kind of with the maturity of your business. So as the business matures, and your clients become more and more financially secure, the need for some of these products kind of does fall away. And if you're doing your proper job, you'll tell a client, we've done the analysis, you do not need that life cover, or you do not need that income protection or whatever, because you are secure now. And that, after all, is kind of the financial engineering piece in, the financial planning process, that you're not wasting, it's dead money if your plan has told you don't actually need it. So I think I'd be the exact same as you, Alan. When I would have started out, there would have been a lot of requirements for these kind of products, but less and less so going forward. We would do a good bit of Section 72, which is basically inheritance tax, life cover policies to cover tax bills. And we have actually replaced some life policies with these kind of rediverted the money to save inheritance tax down the line that heretofore was being paid for life insurance. So I do think it comes with maturity, and I think that's all about the financial planning process.
They're saying about this review, obviously commission is going to be a key thing that they're going to be focusing on, because at the moment you could still take commission via protection, even though you need to declare it. And they've given an example of, would a typical client be happy paying £750, which they say might be the minimum fee for a financial advisor to charge. So again, it's just going to increase the advice gap if there's a lot of tinkering around the commission side of it. But yeah, we will see. But yeah, similar points to what Carl mentioned about types of clients we look after. A lot of them are financially independent in their own right. The average age to look after now is 59. They're slightly older. It's normally mortgage and protection advisors that are obviously heavy in this space, dealing with younger clients and debt and stuff. So yeah.
And in that scenario, it is required. What are the commission levels for life insurance products over in the UK? Like they're
very simplistically, just whatever the premium is, times it by 20. So if it's £100 a month, times it by 20, that's £2,000. Generally around that level.
Yeah.
So what? 1.5 times the
180%
payment.
Yeah,
180%.
It's similar here. Yeah. So it's large, but like there is a requirement for it. So
yeah, it needs to be sold. Protection is sold.
100%. Yeah.
People don't wake up and think, I'm gonna shop around for income protection today. They go, no, I'm gonna book a holiday and buy a load of crappy clothes online. They're not gonna seek out an advisor and buy income protection.
Nicholas,
totally on that. Much as we all of us agree that RDR was a good thing. And I know, Carl, you'd love it to happen in your country, and the stripping out of commissions from investments and so forth and pensions.
Yeah.
But I do think commissions in life insurance do play a role. If you're a young couple, you've got a mortgage, and now you understand that you need to pay 30, 40 quid a month for life insurance and maybe critical illness, to then be invoiced 750 quid. You'll just see protection sales fall off a cliff. People just will not do it.
Agreed.
So I have
750, Nick, is the minimum that they're quoting as just.
I know that's the figure. That's
exactly.
Exactly.
Could be a couple of thousand easily, and people just simply aren't going. Very few people are in that.
And you can explain to your blue in the face that if you reinvest the commission, rebate it, that pulls the premium down over the life of your contract, you're going to save X. People don't care. They've got.
Well, it's effectively a loan to the client given by the insurance company.
Something which gets little airtime, but we've spoken about it a bit on here, is the protection payout rates, because the companies now, their underwriting is so fine-tuned and sort of they've mastered it. When there's a payout, they pay out almost immediately, and the payout rates for all the large insurers now, we used to say above 90%. Most of them now are way above 95%.
Yeah.
I think Royal London had a 99% payout last year because they don't want to dispute anything. They don't want the lawyers to be backing and to and fro. There's an £85,000 critical illness payment. By the time the clients put the phone down, they've done the transfer. They just want it out their lives. So they don't want to dispute things, which is, the sort of fear of people taking out these policies. The payout rate is just astronomical. So, I'm all for more human insurance.
Super important, very important for people at a certain point in their life and their journey. When they are younger and you're taking on a lot of debt and you've got young kids and all that sort of thing, definitely get protection. But I guess all of us our clients have grown older, become more
slightly
mature,
wealthier,
become more financially secure, and therefore the need, not saying it's not required at all, but the need is certainly reduced. Interesting. Okay.
Yeah, definitely. Okay. That was quite interesting. That was. We managed to we spun silk out of that.
Looking for energy here, so maybe some music or something.
Yes. Just beef it up.
Come on, boys, you can do it. Come on.
We can do it. Okay, Ultra, life recordings.
Yeah, I saw this in the Times a couple of weeks back. There's a company called lifestoryrecordings.co.uk. Really good, amazing little company. They basically rock up to someone's house, let's say usually an older person, like a mother or a father, and rather than you sit there with your iPhone and ask them a load of questions, it's professionally done. The prices they charge are astronomically cheap, I think. Basically, it's £1,000, £995. They'll rock up someone's house, they'll sit there for a day, they'll ask them a load of questions, they'll edit the film beautifully, 60 minutes, and you've got it as a sort of a memento. I know, Alan, you've looked at this a little bit with your dad. I know, Carl, you've sort of spoken about it with various clients. You've done it. Obviously, you and Gorgeous George, I think, went up there and did an interview.
Yeah, did a whole days of recording, which was
okay. So it's
that was a lot of hassle.
If there are any advisors that have clients that are thinking about putting something together, then check it out. lifestoryrecordings.co.uk. And as I say, I think it's reasonable. £1,000.
I will check it out. We are going to do something like that to jump on the idea that Alan sowed the seed with me on, but I think it's a really, really nice idea.
There might be an equivalent in Ireland. I'm not too sure. I'm sure they'll fly over and have a day in
accommodation.
Hardly for €1,000.
But if it was £1,000, for some of your some clients for sure, and particularly if they are elderly, getting older, it's that sort of time. You want to capture this for the children, the grandchildren. What a beautiful gift that would be for an advisor to be able to give to some clients. That's a good one. I'll check it out as well.
It is decent, yeah. I'm sure they're probably inundated since they've been featured in the Times. They're probably going to jack up the prices.
Since they've been featured on Trap, they're going to be inundated.
Yeah, exactly. Well, we're the people with the connections, financial advisors.
Well, this is true. This is the Trap effect. It ripples through the universe. Okay,
It does,
good stuff.
slowly.
Wodge, Standard Life survey.
Yeah, Standard Life did a survey basically on kind of what is bothering people who are approaching retirement. I just thought I'd mention it because, do you know what? Nearly half of them said, are we going to be okay? So I know we all know this, and I know it's, we're kind of flippant about it sometimes, and we are going to be talking about investments, and maybe we're talking about investments too much. I don't know, because, we're going to have this job of ours is going to be in front of us forevermore, in my opinion. People want to know the most basic question. It's like going back to Maslow's hierarchy of needs. Are we going to be okay? So I just thought I'd mention it. Yeah, it's really, really important.
I'm amazed, Carl. They're saying almost half feel financially unprepared. So half feel financially prepared for retirement? I think if you lined up 100 people on the street, I think like 3 of them would say, yeah, actually, I think I'm ready for my retirement. So it's quite interesting. Yeah. I think it's quite pro.
Well, a fair percentage will have a defined benefit working in the public sector or something.
But they still feel a little bit anxious about it. They wouldn't say,
I'm going to get a pension bulletproof. X.
But that might also be the sort of the Donald Trump thing. They don't want to admit that they haven't prepared for it because they might feel a bit embarrassed.
Yeah, they don't want to feel silly or something. Yeah.
Yeah, but don't we all know loads of scenarios whereby people think that they are going to be okay, but they're not sure, and they just need that reassurance, and that's what the financial plan will do, and that's what the financial planning process does, because year on year life throws these curveballs. Hopefully not year on year, but life does throw the curveballs, and we'll be there to, say, okay, well, we have this curveball, let's put it into the model and let's see how we're fixed now. So I just thought, now the survey doesn't say, are we going to be okay? But that's my summary of the survey. That's the question that people are waking up at night thinking about.
I think most people underestimate how much actual money and cash they need to accumulate and create to be financially bulletproof in retirement. A lot of people say to me, I think I've got enough, Andy, because they think like 300,000-400,000 is going to be enough. They quickly work it out in their head. I'll just spend a bit of that, and then it's like, well, you need to times that by about 3 or 4, my friend. Like, you're just getting started.
100%. And then the other thing, the defined benefits of civil servants or whatever, right? With defined benefit. Do you know what I found often? Is that they don't know, well, they know what they're going to get if they stay till 65, but a lot are like, can I go early? Yeah. And they have no idea how to even go about trying to find out what kind of pension, what kind of income they would get if they went at 58 or 60 or 62. So, look, that's what we do. And people are telling us through surveys like this, that's what they want.
And do you know, within those numbers, or any sort of survey, ask 1,000 people, 10,000 people, some of the ones who say, yeah, I think we'll be okay, definitely won't be. Because I'm always reminded, so a few years ago when somebody came to see me, and it was just, I just want to sort of bounce something off. You just want to double check, but he built quite a useful retirement model in Excel, quite a whiz on Excel, with one fatal flaw, which I saw straight away. Didn't build in any inflation.
Yeah.
So, I can retire on 60 grand a year, plus I got this, and my state pension will kick in then.
It could be argued what he did was right. It's in real terms. If the numbers were sort of
if the numbers were, and there was assumptions for growth, which were, you were. And well, as soon as I said it, I said, but everything's just flat line. There's no inflation. And went, oh shit. He says, can you imagine the difference that makes on a 30-year retirement?
Oh my god!
It would likely not include tax, Alan, to any degree, unless you just shipped it off.
It was absolutely flawed, and this is the issue. People that are doing.
It's like I built the perfect aeroplane, but I forgot to put the wings on.
Yeah, no. It's perfect in every other regard, apart from the wings.
Take off.
And there's,
Well, I mean, just to echo Carl's words, and for younger advisors who are out there, and I've wished on about this for years, begin with the end in mind and build a practice around answering the one key question. And the one key question is, are we going to be okay? Clients may never emote that directly, but that's what they're thinking. And that's what they want you to answer for them. And they will pay you handsomely for doing so. Give people money, peace of mind. Right. Storyteller, woven advice.
Just a quick one for those this may be of interest to. There's a company called Woven Advice, who it's advisor data tracking. Effectively, I know, Carl, you've got your own version of this in house, but we've all got. May not apply to you guys running solo operations. Maybe you quite got a good handle on your data, but as a business, we've got lots of data sources coming in. We've got a back office system. We've got marketing, we've got sales, we've got pipeline, we've got regulatory data, a bunch of different things coming in, which is we've been using Power BI, which is the Microsoft tool, but it's very, very complex. You've got to kind of download the data one at a time from various different sources. It's a bit fiddly. But what Woven Advice do, they aggregate all the data and they plug into a lot of the existing design specifically for financial planning, financial advice companies.
It does look interesting.
And it gives you a really nice, elegant dashboard, which you can, whatever it is that you want to track, which is important to you. And it could be about growth, assets under management, new clients, net new assets, all that sort of stuff.
Are you using it, Alan, or not yet?
Yeah, we are. We are trialing it. We are trialing it right now. Shireen is doing a great job and she's using it. And there's a couple, for all the main things, there's a couple of other sources of data which are yet to be plugged in. Everyone talks about APIs, and there's quite a varying degree of what APIs really mean. Some work properly, seamlessly, and some don't really do. But we are putting it all together, so we're going to have a really beautiful, elegant dashboard where we can track both kind of trailing data, historical data, as well as future trends as well, analyze future trends. I mean, it could be a subject of another, I know Nick will throw his toys out the pram, but a subject of another conversation, because certainly when I showed Carl, when you showed me when I was over in Limerick a while ago, I thought it was brilliant what you had. Is that a proprietary system that you built yourselves, or?
So basically, it's
unlikely.
called, for Irish advisors, it's called Tishkent, which is Tishkint.
I think you mentioned that before.
Yeah, it's really good. Basically, how Tishkent was born. A client of mine, I was sitting down with him and telling him we didn't even know how much AUM we had, and he went off and he's a whiz on the computers. That sounds like a dinosaur kind of thing.
He's good at those computer things.
Control Alt Delete.
Yeah. Turn it off and turn it back on. Anyway, he went off and so he developed this thing over a number of years. He's since been kind of bought out. Great guy, and now it's available to all advisors in the market. So we have this dashboard that everyone logs into. We put all of our client notes in it. We can, it's absolutely fantastic. I know we are meeting up shortly, so I'll certainly bring.
I hope he's still not charging you a monthly fee, considering you are the reason the business developed.
Yeah, he's a great guy, and I wish him
Carl
all
would
the
have
best.
negotiated a mutually beneficial arrangement.
I would highly recommend,
especially anyone who's good at those computers.
Yeah,
good at computers. Very, very, very good. But it is interesting. We are sort of business, generically financial planning companies. There's a hell of a lot of data within our companies, but there's very little to aggregate it, streamline it, sort it out, and make it meaningful and useful because it's coming from multiple different sources.
So the guys in Tishkent have gone to all the providers, right? Yeah. And they've got the data feeds from all the providers, and obviously that was not easy, because obviously you have to make sure everything is secure and blah blah blah. So there was an awful amount of work done in the background to get all of that done. But it is really, really fantastic, really, really brilliant. We'd be lost without it. We would really be lost without it.
So anyone in the UK, check out Woven Advice and speak to them if you're interested. But we're using it. It's good.
I'm looking at tishkint.com. Is that right? Tishkint.
Not to be confused with Tashkent.
It pops up.
Don't push it. Don't push it.
Pops up on my laptop when I open it in the morning. I know you have to log in, and there's.
All right, good.
Anyway, it's very
Peter Romani.
Yeah.
Cool.
Yeah.
Okay.
All right.
So our new government apparently has found a black hole in the public finances of £22 billion, which you didn't know about before it became the government, which I struggle to believe, because I thought all incumbent potential governments were briefed thoroughly by the office of whatever it is, the one that always gets everything wrong anyway. But apparently they found this £22 billion black hole, and they've got to fill it. And there's an October budget coming up, and none of us ever make predictions. We don't know what the future holds, right? But I can tell the dear Trappists that there won't be tax cuts galore in this budget coming up. That's about as far as I ever go.
That's a reasonable guess.
It's a reasonable, prudent guess. So I've just started. I don't know if you guys are doing it. I've just started to get from clients the odd questions about realizing some assets now. So I've got a client couple who I'm seeing later this month for their annual planning meeting, and they're spending some money on this overseas property. It's a 7-figure sum, and they want to know where to take the money from. They've got a GIA, they've got ISAs, they've got personal pensions, and they're old enough to access their personal pensions if they want. And their question is, should we take it from the GIA? Given that I think it's, again, this is not advice, and I'm not categorically saying this is happening, but I'd be very surprised if capital gains tax does not come out of this budget unscathed. And there is talk of aligning capital gains tax rates with income tax rates. They're currently 10% and 18% for that listener who listens in and criticises me for getting CGT rates wrong. I have Googled these. And I just wondered how you guys are you experiencing these kind of questions yet from clients? I'm leaning with this particular couple to saying I would take the money from the capital gains tax, the GIA element, if you can, because those taxes are only ever going to go one way.
You mean take the 20% hit now, Nick, rather than just take a tax free out the ISA? Again, I don't know the numbers. There's more to it.
Yeah, I mean, I do the cash flow as well. I do various what-if scenarios, but it's just, it might just be a case of, listen, if the rates go up with capital gains tax, they're probably going to stay at that. I can't see them coming down, even if we get a change of government.
The allowance won't change. The allowance won't change because it's on the floor anyway. So they've already
you might get rid of it.
That.
I mean, it's just
I think
3K.
that the headline rate will go up, definitely. I mean, they tweaked it down on CGT on additional properties, which was ridiculous. That wasn't needed, was it? 28 to 24 or something. Anyway,
that's right.
I think it's going to go up.
It used to be really complex, didn't it, with indexation?
It's horrible.
It's a complete nightmare. Yeah.
You just don't want to do the calculations. There's computers now that can do that. And it's got nice and neat and simple, and it is relatively low, I suppose, currently. So they've already stated that they will not increase income tax or inheritance tax, I believe. So it's an obvious one.
Maybe they can increase CGT, but the old historical entrepreneurs relief that's now called BAD, maybe they should be kind to these people that create a lot of tax in the system, as in entrepreneurs.
They don't care.
It'd be very difficult to come in.
Well, they did care because it used to be 10% on 10 million, so they did care at some point. Anyway, we will see. But
they've come in on the basis of building Britain, growing enterprise, creating a more vibrant economy. So they can't just slaughter business owners.
Let's just keep it simple, Nick. And let's say CGT goes from 20 to 40. Do you think it will happen immediately on the announcement? As in, you will have no.
That's an interesting. That's because in this group that I run, I might have mentioned it. Tiny.cc/IFA forum. There was an email today, and one of the questions posed. Yeah, do you not know about it? One of the questions was posed was if this happens in the budget, do you think it'll be immediately, or do you think it'll happen on the 6th of April the following year? I'd imagine they'd have to do it immediately, wouldn't they? Otherwise, you just get a mad rush for the doors of people selling out to lock in at the lower. I'd be very surprised if it wasn't overnight things.
You'd have to.
Yeah.
They would have to.
Well, you've got a dilemma with those clients, then, Nick, if they've got a liquidated.
But is your CGT rate 20%?
Basically,
it's 10% for basic rate taxpayers, Carl, and 20% for high rate and additional rate taxpayers. What are the rates in your neck of the woods?
33.
Just a flat.
Yeah, it's like entrepreneurs relief is 10% on the first million or something like that. So
and then 33 on the rest.
Yeah, but an exit tax is on funds is 41.
I think 33 would be fair if they introduce that.
You mean
if they align it with income tax, I think that's just way too harsh. But anyway.
Sorry, what's this exit tax, as Alan was trying to ask before he was talked over again by Andrew Hart for the 58,000th time?
And we've received a message about that, haven't we? Exit tax on funds, right? So your Dimensional fund or your Vanguard fund is 41%. And it's every 8 years, whether you take the money out or not. So I've been banging on about that to say that's, we're trying to.
What do you mean? If you haven't even sold, you still haven't.
There's a spike every 8 years. Yeah.
And capital gains is not payable on death, so there's a massive discrepancy there. And then it's
same here.
Same here. Yeah.
So it's whereas it's deemed after every 8 years an exit tax. So I've been banging on about that, and there's a something else I've been banging on about. So it's getting a little bit of traction, but probably not even.
I think all the left-leaning governments around the world they must all read from the same script, because on the last episode of the All In podcast, they were talking about this proposed tax that the Democrats are going to bring on unrealized profits. And that just sounds to me like a nightmare.
On what assets? Who knows?
On investments, on business
anything.
assets,
If
anything. And you'd have to, and of course, until you sell an asset, you don't have the readies to pay the bill. And they're saying, they'll give dispensations and they'll be wait.
You can pay it over several years. Yeah, I know.
Even monitor that? It's just like nightmare.
Yeah,
nightmare. To answer your question, Andy, what route will I go down with these clients? Well, this is the joy of having world-class cash flow modeling software. I'll just do the various what-if scenarios, taking it from different pots, different amounts, and just see what's the better long-term outcome for the client.
I'm sure the ISA
again,
will probably win.
That software to hand, I don't know how you even begin to do it.
I'm sure the withdrawal from the ISA will win, but interesting.
Maybe. But then in retirement, the clients are going to draw down on the GIA for 30 years.
But it will be a
maybe
staged
40%
amount rather than a big hit now. But okay, interesting.
Yeah. Okay. Thanks, gents, for your time on that one. Voice. How do you even say that? SISA?
Oh, the SSIA, yeah. So this is, kind of following on from that previous point. So we used to have it, the SSIA, which was kind of a version, but much smaller, whereby if you put in, I think it was 200 quid, that government would top it up by 25%, which is a kind of a version of the ISA. So there is a little bit of talk about, there's an awful lot of money being saved at the moment. So, can we also have a housing crisis here where all the young folk can't get on the housing ladder. So maybe this is something that they can look at introducing. I'm not sure. We have a budget coming up as well. It's first week in October. Not sure it's going to be introduced just then, but I think some version of an ISA here is looking more and more likely. And if we can just keep it on the agenda, it would be fantastic. If we can encourage a culture of saving, then, and real investing and saving, then, I think we'll do well if we take a long-term view. And that's the problem with politics and budgets, of course. It's like we've an election coming up. So this is going to be, we're going to have, tax cuts all over the shop to try and buy votes. It drives me insane. But anyway, that's politics for you.
Yep, ditto.
I was pretty blown away, Carl, by the percentage of after-tax income that Irish people are saving. Historically, it's been a lot higher than a lot of the developed countries, and now it's at 20%. Obviously, it peaked during COVID because people couldn't spend money on anything. So,
yeah,
it's pretty impressive. Is that like a cultural thing or what? Because it's much higher than the UK. UK is like low single digits.
Well, it has gone up dramatically in the last few years, but I'd say if you know your history, as they say, the financial crisis here was everyone had 4 properties. They had 3 investment properties, probably 1 in Bulgaria, and it was debt all over the place. And culturally, I think we learned our lesson. So there's a lot less debt, which is really, really good. I think we've kind of grown up. And they'll also see that I was deeply uncomfortable with the content of some of today's podcast, owing to the Irish versus UK cultural differences. I'll point out again, Nick, that every time you play that, it costs us money that we do not have. So.
That we're not getting, yeah. I know. Is that the
demonetized? Demonetized again.
Yeah.
So, but yeah, but kind of to follow on from that point, Andy, it's all then been put on demand deposit accounts in the banks.
Yes, yeah, banks,
I
get that, but still,
the banks'
same percentage
profits
is
are going
high.
Massively up because they're not putting them
banks
into
are
term deposits.
Ireland having a massive saving culture.
That's changing. That is
Very
changing because
slowly,
people are
as these things do. Yeah.
Slowly, exactly. Yeah. So anyway, yeah.
Interesting.
Okay.
Thanks, Scott. Looking at our YouTube channel, we're at 894 subscribers, so we're not only 106 away from the magic 1,000, where we definitely will not get money that would otherwise come to us. And we've taken on 39 subscribers in the last 28 days. So thank you to those 39 new people on YouTube watching us 4 jabronis whittle on and whittle away. Okay, we're coming towards the end of the topical time tidbits. We've got one more thing to do, and that is Ultra. I don't even know how you say it. Norges or Norges? Norges, I guess.
Norges Bank Investment Management. This is the...
Is that you say it? Norges is pronounced Nords.
Yeah, I believe so. It's the Norwegian...
You're not sure, are you? You're
I don't think
bullshitting.
so.
I'm sure.
Norge.
I wasn't sure. I'll be sure.
Norge, the Norwegian.
Say it again, Andy.
No, don't worry. So it's the Norwegian Sovereign Wealth Fund. So question to you guys. The Norwegian Sovereign Wealth Fund, in the first half of 2024, how much did the fund increase by? Give me a number.
In the Norwegian currency.
No, nothing to do with the Norwegian Sovereign Wealth Fund. So the
8%.
money... No. Give me a monetary number.
monetary.
That's what I'm trying to get out of him. Yeah, okay, right.
Yeah.
In
What's
what,
the question?
dollars? Sterling?
You can give me whatever you want. I've got it all on here.
4 trillion.
7 billion.
Good, Carl. Thank you for giving a sort of reasonable guesstimate. Okay, it's gone up.
23 million yen.
The yen is not anywhere near that, Nick. Anyway, it's gone up by 1,478 billion kroner, which is 105 billion sterling, 138 billion dollars.
That's
The
what I meant to
Norwegian
say.
Sovereign Wealth Fund has gone up by 138 billion dollars in the first 6 months of this year. It now stands at 1.6 trillion. So anyway, they came out with their results. The founder, or the CIO, has got a podcast which is very interesting.
Yeah, it is, yeah.
And their equity element has gone up by 12%. Their fixed income has gone down by -1%. Their real estate has done -1%, and their return on unlisted renewable energy infrastructure was -18%. They basically bought 9,500 public companies. They're about 70% invested in global equities. It's a very interesting fund. So the Norwegian people are incredibly wealthy. If you divide the total amount of people by the 1.6 trillion, it's now the official biggest world sovereign wealth fund. China have a couple, but in terms of an individual one, it's the biggest. It's quite an interesting story. And they keep it very simple. I think there's about 45 people that work in the investment team that look after about 1.6 trillion. So, yeah. I thought
I've mentioned him before. There's a brilliant podcast episode where he interviews Michael O'Leary.
Yes, it is good.
Oh, yeah, that was
really
great.
good. Very
really
candid.
good.
Yeah,
Talked
Michael
about it,
O'Leary is
yeah.
obviously a sharp cookie. Yeah, it's really good. Nikolai Tangen, he's called. If you
Yeah,
like to
that's
pronounce
right.
that again. Nikolai Tangen.
I think you got that right. Now, hold on a second. Let's just see something here.
You could have pronounced Nords. What are you doing?
Norges. It's Norges Bank. Norges Bank.
Norges.
I'll put a link to the correct pronunciation in the so-called show notes, dear listener, but it is Norges Bank.
So what you were saying, Andy, in other words, linking the last couple of conversations, is that they have increased in value by about in the last 6 months, by about 5 times the amount of our UK apparent fiscal black hole.
Yes.
Yeah, so
They're a net positive
we're
country with
scratching
no
around
budget deficit. They are
we're scratching
loaded.
around looking for 22 billion down the back of the sofa.
And they've made it.
100 and
They've
something.
made it out of this thing called the stock market, which I call the closest thing to magic. 105 billion has been created in the first 6 months of this year. They're now stood at 1.6 trillion. It's insane, these numbers.
But
Anyway.
if you guys in the UK are stuck for 22 billion, like we're making that in corporation tax profits, like probably on a monthly basis. Just give us a shout. We'd be happy to help out.
Well, you're based in Norway, aren't we? So you're probably contributing in some way to that. Tying a bow and everything.
And you thought I was a
Metis
fool.
Norway.
Never.
We thought this was a joke. Turns out to be true.
Right. Good stuff. As ever, somehow we've managed to make topical tidbits last almost, again, 44 minutes. It's always between 40 and 45 minutes, more or less. And we've come to the end of topical tidbits. So let's move on. Let's move on to the meat and potatoes of episode 53 of the Real Advisor podcast. For those of you watching us on YouTube, you can see I'm now struggling with I struggled with my 4s. I'm now struggling with my 5s on the high-tech digital whiteboard behind me. The meat and potatoes today was inspired by a guy called Robin Wigglesworth, who's a writer for the Financial Times, and he had an interview recently with Dr. Gene Farmer, the architect really of something called the efficient market hypothesis. Interesting article. It is behind a paywall, but there are sites that enable you to go behind paywalls. I'm not sure whether I should be boosting them or not, because I'm a bit dubious about how ethical that is, because that is some company's IP. Anyway, it's an FT article. He interviews Eugene Farmer, who he's 85 years old, won't be around forever more. He's still as tetchy and as driven as he ever was. An interesting guy. And of course, Farmer is famous for the EMH, the efficient market hypothesis, for his work with Ken French on the 3-factor model, the size and value premium. And I know that we are all big fans of and they hate this phrase, but I'm going to use it as a catch-all, passive investing, index investing, and the dimensional approach to it, and the work they do in terms of education for us as advisors, and then stuff that we can give on to our clients. They just throw it at us. Everything is ultra transparent. But the efficient market hypothesis is one of those lightning rod subjects that seems to agitate as many people as it excites or convinces. And Robin Wigglesworth, I put a link to it in the so-called show notes. He put a LinkedIn post referring to his article, his interview. 112 comments the last time I checked on this, and a lot of them are slating the efficient market hypothesis. And I'm going to read a couple of these out. Some of these people are right in the weeds, and they probably don't have a big circle of friends. It's not a theory, it's a hypothesis. As Farmer himself points out, it was disproved in the 3-factor paper. Kappa and beta has a t-squiggle stat of squiggle 0.8 and only squiggle 1.2 when combined with size. That is far below the t-stat of 2 required. Blah, 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 blah. These people go on and on. Somebody else says, EMH had a lot of assumptions that have to perfectly align like the stars for it to come out true. In real life, it never works out for individual stocks. Now, I think there might be a disconnect between what I certainly understand EMH to be and what its detractors say it is. And so I want to quickly go through it, and then we'll just bounce this around the room, because in my business and in what I do for my clients, and then this thing of ours, for all 4 members of the Trap Pack, DFA have played a major part in our progression, and I think they add a lot of value. And it's obviously built around the work of Farmer and French. So what is EMH? And in my simple mind, I try and keep things simple, right? Because I'm not, I've got a P-shaped brain. This is my definition of it. Eugene Farmer wrote this paper back in 1965, The Random Walk of Stock Prices. Long story short, and he is very mathematical. And if you ever see photographs of him in front of his blackboard, it looks like it's just like a word vomit with some brackets thrown in. Just incredible formulas. My understanding of it is that basically what Farmer said all those years ago, and he's won the Nobel Prize in economics for it as well, is that it's really hard. All the aggregation of all the players in the marketplace, all the now, certainly, but back in 1965, but now with the computing power, the algorithms, the analysts, it's very, very, very hard to find a security, a slice of equity in a company that is not appropriately valued. Everyone's going through balance sheets all the time. And that's to me, that's what it is, the efficient market hypothesis. And on the back of that, of course, that very simple statement, you've had this rise of the index funds, which kind of proves that, well, something is right here, because it's very, very hard to beat the market in aggregate. And we every year we see these reports that are coming from Standard & Poor's and so forth that just show how many active funds, especially in the very developed markets like the US and the UK and Japan, it's really, really, really hard for these active fund managers now to outperform over any sustained period of time, which to me indicates the efficient market is very, very efficient. I think where people get confused, or maybe I'm wrong on this, but the detractors of the EMH say, well, it's not efficient because you get things like the tech bubble and you get these booms and bursts in the market, therefore they're not efficient. And I don't think by the way, in the interview, Gene Farmer's very honest. He said, "There's only ever a hypothesis. It's an evolving work in practice." But I don't think Gene Farmer ever said that markets are rational. The EMH is not about that. To me, the efficient market hypothesis, and which underpins all of DFA stuff, fundamentally underpins how Vanguard has done so well, and the index trackers, is that markets are ruthlessly efficient. You can't find these mispriced securities. You're better off buying the market in aggregate, and then if you want us to stick a bow on it, you can then delve down into the size and value premia. Now, that's a bit more debatable because those premia disappear for long periods of time, as we all know. But certainly the EMH, in terms of finding an undervalued security, to me works. So I in the round, I'm a big fan of. I think Gene Farmer is brilliant. I think DFA are brilliant, and I am just an advocate for the EMH. Is my understanding of the EMH correct? Is that what you guys think it broadly is?
Simple answer, yes. But again, there's many moving parts to it. But yes, fundamentally, I sort of concur most of what you said.
So do you think the pushback against it is from people that perhaps have a vested interest?
Inevitably,
there is
they're just waiting to just again do paragraph after paragraph about investment BS. It's just
look. I think here's my take on it. I think you've summed it up pretty well, there, Nick. My understanding of what it is. I read that article. It's very good, by the way. He's quite a character. Is Mr. Farmer, and this is all about. Yeah, as you say, the price of the security reflects all known information. Information has never moved as fast as it does now. Within a fraction of a second, information is available to everyone in the combined market. So inevitably, that's how prices are formed. The argument that some people have against that is, well, how come Warren Buffett has outperformed the market? How come, and several people have consistently outperformed the broader market over the longer time. And the answer to that is assume that you're not Warren Buffett. Assume that your fund manager managing your portfolio is not one of these handful, literally tiny handful of people who seem to have bucked the trend of the last 100 years. And that's why they're so famous, because it's so unusual. And people like Buffett seem to be able to, or historically anyway, to see anomalies, to see where securities have been mispriced because of something he's read in the balance sheet. And there is evidence of that. But of course, you've got literally a multi-trillion dollar pound industry that if this happens to be true, if the world believes it, they're out of work. Because that is the fundamental premise of the active investment management industry, is that the market is inefficient, and we and our experts and our economists can spot those inefficiencies and trade and take advantage of them consistently over a long period of time. And there's scant evidence of that being the case.
Buffett and Munger are big detractors of the efficient market hypothesis. I don't know if you've heard them speak about it, but that's sort of by the by. Yep. The thing that always blows my mind, there's more funds than companies, which again is just insane.
Well, there's incentives.
Which is I do remember having a very entertaining dinner with Eugene Farmer's son. I think he works at DFA. Did any of you meet him? He was a very interesting character. I don't think.
Yeah, I didn't meet him. I'm not as ultra crepidarial as you, but I did go to the foundation's course. He was there about 15 years ago. He was
he's an interesting character. I don't think he's winning a Nobel Prize anytime soon, but interesting character. Anyway,
why do I know you've read all 3,000 of the Berkshire Hathaway annual newsletters. Can you summarise for us, Ultra, why Buffett and Munger weren't fans?
Well, not in a sort of elegant way.
I didn't ask to be elegant. I wouldn't expect it. But can you just give me a summary of what
they were just saying? How could we possibly outperform the market if the market was efficient? Thinking the market's efficient is ridiculous. Well, obviously, the market's a collection of humans' opinions. So, back to your point, it's not rational. So they're focused on the human participants in the markets. You're right. Over a 30-year period, about 1% of funds are going to beat the market. So that tells you the answer. But again, people don't care about the long-term numbers. They're just bothered about now. I think for now, the market is pretty inefficient. How could you assume a different price if that makes sense? So I'm all about the price being the price at the time. Long-term, I think markets are quite inefficient. But again, it's not really my wheelhouse. Carl, over to you to shine some light.
Yeah. So for me, it's all about the best way for us to be able to put our clients into something that we can believe in the long term is to base it on the evidence that has gone before us. So that's what DFA do, right? It's an evidence-based investing philosophy. Will that be the very best outcome? It won't be, right? Because there'll always be people who'll, fly ahead. But the evidence tells us that this is the best thing to do. Now, that's whether you're doing indexing or whether you have the dimensional, the various factors. And I see very recently, I got an email from Dimensional, and going back to their evidence-based investing philosophy, they had how often do small cap value, how often do they outperform? So they're giving you the evidence, and they're not saying it's going to be 100% of the time. They're going to go, however, most of the time. So the evidence is stacked in your favor. In the same email, there was another article where Dimensional are having a pop off index investing. Now, for me, I don't know, is that productive? And I'm not sure getting into the weeds of the investing and talking about Eugene Fama's views on the efficient market hypothesis is necessarily going to make us better financial planners. And for me, it's, look, we're going to base this on the evidence that we have in front of us. It's going to stop us going into the next best thing. We say, I'll have a look at Bitcoin, my favorite one to look at, right? So Bitcoin is up 28% this year, but it's down 20% in the last 3 months. So I know, because I'm experienced at this, that that's far too volatile for me to be able to keep my clients in their seats. And whatever your investment philosophy is, if you have something that you can buy into and that you can convince your clients is a good idea, well, that's the best strategy. And I think getting into the weeds of it, and I read the comments on that post from Robin Wigglesworth, none of them are advising clients in the real world. Absolutely none of them.
No way, not in a million years.
They're not.
You can tell
They're, I tell you what they're doing. They're running actively managed funds. That's what they're doing.
Yeah.
They're, putting in, I read it. It's absolutely ridiculous stuff. We are working with real people in the real world. And if we try and overcomplicate these things, then we're actually just going to get in our own way. And we're also going to get in our clients' way.
Yep.
So we've decided that an evidence-based investing philosophy, I think everyone in this group, certainly Metas Ireland, have decided that an evidence-based investing philosophy is the best way forward. We're sticking to it. We have stuck to it, and we will be sticking to it going forward.
But also, you've seen it work. Also, you've seen it work, Carl, with real clients. You've seen the wealth being created. So, you've got skin in the game and actually seen it happen. Yeah,
100%. And it ain't rocket science, although people try and make it rocket science, right? And they try and way, way, way overcomplicate it. And for me, what would I do if it was my money? I would do exactly what I am telling my clients to do.
Exactly.
Full stop, end of story.
Yeah, agreed. I think we've obviously, all of us on this and many others have arrived at this conclusion over many years. And I think what eventually happens is that you reckon that the investment piece, you need to have a very thoughtful, we've spoken about this many times before, we need a very thoughtful investment philosophy, but one that you will back up all day long as much as you can articulate that. And if someone wants to go deeper, and occasionally you have clients and prospects who want to say, yes, but tell me more. Where are these academic papers that you refer to? I remember we had a client who asked exactly that a few years ago. Unfortunately, you go and speak to Dimensional, fill your
Here
books.
You go, mate. Here's 3,000 pages. Knock yourself out.
And this particular client actually read them, which is another story. But this is the point. So I'm just thinking commercially as well. I want to keep things just really simple. And I want something that I can believe in, that I can stand behind, that to some degree I can articulate and explain to clients, prospective clients. If someone wants to get more and more and look at the evidence, they can do so. This is stuff which has won Nobel Prizes. This is not made up Mickey Mouse type stuff and people comparing charts. And the data goes back literally for decades and decades and decades, and it stands up. That's the point. Now, is it perfect? Could there be some flaws in it? Maybe. But I'm all about the balance of probabilities. I'm all about saying that there seems to be sufficient, compelling data evidence, which has been reviewed by other experts, and they say, this stuff stacks up. And just stick with that. Stick with the program. Of course, you update it, you review it, and there's always new papers coming out and new research is being created, and you go in with an open mind, and things can change over time. But fundamentally, the efficient market hypothesis does work, does make sense to me. There's the occasional time when you might question it, but look, I'm in it for decades, and it seems to stack up.
And to your point, like, are there flaws? Yes, there are. It's not like that there may be flaws. Of course, nothing is perfect. You can't have the perfect investment philosophy.
It doesn't exist.
It doesn't exist. We're recommending the best we possibly can. I am interested, as you boys know, and you all think I'm wrong, I am interested in finding out better ways or more ways of helping our clients get a little bit of comfort that this is the best thing. I am definitely going to look at that much more closely.
You've hired someone, Carl, to help you with that, haven't you? Really, or is that for another day?
That's for another day.
That's for another day. Okay, fine.
No, exactly.
Okay.
But again, if you think, hold on, Andy. If you think again, as I'm trying to sort of refer to it more, commercially, if you're running, and most firms in the country are relatively small financial planning companies. If you think about the unit of energy or time, resource, money, everything being applied to the various component parts. So those firms, and there's plenty of them, who they attend investment company seminars and you speak to the latest fund manager about his views on, what the dollar is going to do against the yen next year and all that stuff. That takes up a lot of time,
Headspace,
a lot of costs, and you're traveling to some meeting or some presentation about it. And if you effectively just remove 99% of that, you still, of course, you keep your eyes and ears open for evolution and changes, but you no longer have to do that. Guess what? That allows more time to be creative, to sit in front of clients, to listen to their stories, to articulate, and to do the proper work, which is
all the
planning.
good stuff. Yeah.
That you've got a world-class engine, just fueling and funding all this stuff that we're trying to achieve. So it's just a better way of operating as a business, in my opinion.
Go on, Carl.
Yeah,
Interesting.
100%. I'll be more bullish about that, Alan. If you are spending time talking to fund managers and your ambition is to, deliver world-class financial planning to your clients, you are wasting your time. You are wasting your time. And that's coming from experience. I used to do it until I saw the light, right? But it's go back to what we said earlier on. The number one question people have is, are we going to be okay? If you can, they're not like, are we in the right fund, or is Eugene Fama's efficient market hypothesis correct? They don't give a shit, right? But they need to know you've thought this thing out. They do, so anyway.
I think it's the greatest professional gift I've given myself. I've been looking after money for 16 years, and 1 year in, I turned off the active management BS, and then I got all in full on dimensional asset class investing. And then for the last 15 years, I've just been focusing on the good stuff, which is the client focused stuff. And the investments is dealt with. Obviously, I need to top up my investing vitamin C every so often, and etc. A similar vein, I don't know if we're going to go on to it or if I should go on to it now, but I don't know if you've ever come across it, but it's Ray Dalio's all-weather portfolio. And a lot of people get right into this as well. I'll just explain to you what it is. It's basically 30% equity stocks, 40% long-term bonds, 15% immediate term bonds, 7.5% gold, 7.5% commodities. I mean, this dude is a credible investor, runs one of the biggest hedge funds in the world. He's got a load of money. He's written some great books. He's a super sharp cookie. And this is the guff, the financial trash he's telling the world to invest in. And a lot of people get right into it because obviously he's a credible voice. I just think it's absolutely horrendous. I mean, gold and commodities gone straight away. Bonds, I'm not too much of a fan of that. My average portfolio is 85% global equities, 15% global bonds, and I'm comfortable with that long term. My job is to control the clients, through all market cycles, get them calmer, more, become more acceptable around volatility, and that's the emission price to long term wealth, blah, 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 blah. Anyway, so any thoughts on Ray Dalio's all-weather portfolio?
Yeah, I read the book called The Fund, number one, and I've only tried to read one book by Ray Dalio, and I got 30 pages in, and I was like, oh my God.
I like principles.
I think you've taken the words out of my mouth. I think I mentioned it on this show. I mean, I've read the biography of the guy, and I tried to read one book of his. My brother-in-law gave it to me, and I gave it back to him. I think, and you laughed at the time, Carl, when I brought that up because I thought it was classic Lincoln. Unreadable guff. And the guy's performance is way.
The Fund?
No, the Fund's great, but I'm talking about one of Ray Dalio's books, and maybe it might have been Principles.
And it was Principles, and that's the one I tried. It was just
me and Alan like Principles, didn't we, Alan?
Well, it's quite hard going, though.
No, we'll come on to your book choices later in the Culture Corner, storyteller. Don't worry, we've got that.
You're being lined up for an ambush, my friend.
Okay. You've been talking behind my back offline.
Yes, we have.
I have to leave early today, so
me and Ray have got a similar sort of IQ level, so it was probably a bit above your boy's station. So
he's a little bit more wealthy than you.
Andy, the ultra crepidarian Andy. He knows about everything, Andy. Can't be told anything. His name is Andrew Hart. Andrew Hart!
Yeah, he's only about 99.99% more wealthy than me. Okay, all right, no worries.
That portfolio, though, there was a time, I think you see the data, if you had you invested that in 1999 for the next 20 years, it would have shot the lights out, as it turns out.
Woulda, coulda, shoulda.
Well, that's why he's recommending it.
Void. Anyway. All right. Done.
Okay.
One thing that's just closing on that, then we're done on the in that FT article, which is paywalled, as I said. Farmer does come out with a good quip. He says, "If markets are inefficient, how come you're not mega rich?" Making the point that go and find these easily undervalued securities and make a ton, which I think summed it up and summed up his personality as well. Okay, great stuff, guys. Thank you for that. We're 65 minutes in. We've still got to do Trappist questions. We've still got to do Culture Corner. So I think we'll. I can see her walking up the drive now, carrying the bulging sack of Trappist questions. Yes, it's the postie. There she goes. As ever, if you want to leave a question for us, please do in the pinned tweet on Twitter/X/whatever, and we will get round to your questions in due course. It takes us a little while to do so because there are so many questions, because there are so many beloved Trappists who just want to, for some reason, get whatever info they can out of our P-shaped brains. So let's have a look at this first letter and see who it's from. It's got a Greek stamp on it from the island of Lesbos. This is from Phil the Greek Dragoumis. Hi, Phil, fan of the show. He's on Twitter as P Dragoumis. Philip asks, excuse me, you all say rightly that investing in equities will outperform inflation over the long term, but currently inflation in the UK is 4% and is expected to fall to below 2% this year. Cash and bonds are still, however, paying us yields of 4 to 5%. This means they have a real yield of 1 to 2%. What makes you so sure that these asset classes won't at least match or slightly beat inflation over the long term for considerably lower volatility? Now, on the surface, that's a pretty decent question, and I think it does deserve some unpicking. Who wants to have a go at unpicking it first? This is what I love about you guys. It's the prep, it's the homework, it's doing the hard stuff when you're not on camera.
This has got ultra written all over it.
No,
definitely
come
not.
on. I've had enough of these. Same questions, rinse and repeat, Our mission is to get familiar and comfortable with market volatility. Volatility is a mission price to long-term wealth. I mean, he might be right at the time. That's not a long-term philosophy and an investment strategy to implement, because we'll just be doing everything at the time. We've got to take a long-term time horizon here, and we know that equities massively outperform bonds by 3 times long-term in real terms. That's it.
I think that's the overarching point here. We try to avoid being short-term tactical. We are long-term strategic. We've got a lifetime to deliver these things to our clients, their clients' lives. So we optimize for that, as opposed to trying to, there is actually currently, as he rightly says, there's a short-term arbitrage. It won't last for very long, and you still get a decent return on cash holdings, and it is probably above inflation currently, possibly. But then that's a whole other question about what inflation is.
Come back. Sorry, Alan. Come back to inflation. The government, the ONS, may churn out a figure that somehow gets below 2% a year. I'm telling you, most of our clients, with their lived experience of inflation, that they are suffering an inflation rate way above bond yields. That's one way of answering your question. And the other part, Phil, is that in the first part of your question to us, you say, and this backs up what Ultra said, you all say rightly that investing in equities will outperform inflation over the long term. You all say rightly that investing in equities will outperform inflation over the long term. We are long-term financial planners. What happens in the short term is utterly, utterly meaningless to us. So
unknowable.
Much like the workings of your inner soul, Andrew, as much as you have one. Right, we are at 1 hour 9 minutes into the show. Shall we move on to what many people call Culture Corner? Wow.
Okay. Is it me? You also moved the
longest pause yet.
Well, Alan, you're going to mention the podcast that I sent to you. Go on, mate.
Yeah. That I was never going to find otherwise without you mentioning it to me. Not one I listen to pretty much every week.
Thank you. You're welcome.
This is not one for Nick, but we have mentioned this podcast before. Modern Wisdom. Chris Williamson. Is that his name? Chris Williamson. Modern Wisdom, and he has an old favourite, Alex Hormozi, on it. I think they're good mates, and they just it's a 3 hour long podcast, and he just kind of unpack all his tweets effectively for the last few months. And I've kind of gone back and forward with Hormozy. I used to love it, read his book last year, a couple of years ago. And then I got a little bit bored of the relentless kind of hustle culture. He's like working relentlessly, but I've kind of fallen back in love with him again. I think he's a modern day philosopher. He just thinks deeply. He's got some really smart ideas, and there are so many. Honestly, I do recommend this to listen to it. There are so many little sound bites. Not everything he says is brilliant, but within it there are little nuggets of just, wow, that's great. How he thinks about that is spot on. So thank you, Andrew, for recommending it. I would have never found it without you. I really appreciate it. And I'm just going to chuck in this one extra thing, which I discovered the other day. If you do consume podcasts, there's a new app come out called Overlap. And what it does, first of all, it interrogates the podcast that you subscribe to. And you can ask for a subject. It's using AI technology. And it's rather than having to listen to all that, if you just want to listen to about, I don't know, fitness, or want to listen to some specific subject, you can then ask it, and it will go and suck up that 1 minute, 2 minute, 3 minute soundbite from any number of podcasts that you either subscribe to, and also some that you don't subscribe to, and then it gives you 5 or 6 of these short summaries of the podcast. It's a decent app. It's free as well. Do check it out.
And Shireen is currently trialing it at the moment, we believe. Like she trials all of your AI stuff, Alan. In fairness to her.
No, this has nothing to do with business. It's just for those that consume podcasts, as you do.
Sorry, do you like it, Alan? Have you started using it yet?
I've just started using it literally 2-3 days ago, and I thought this is really good. And it gives you a few suggestions as to what subjects. If you want to talk about, if you want to get into productivity, for example, but it will give something from Tim Ferriss, something from Ali Abdaal, something from somewhere else, just little sort of 2 or 3 minutes, rather than necessary. Because as we know, a lot of podcasts, there's maybe 5, 10, 15 minutes, which are really super valuable. And you've got to wade through an hour and a half to listen to them, like this one.
Pretty much every Joe Rogan podcast, then.
Yeah, but if you can just say, I'm interested in this subject, this area, it'll go and find half a dozen podcasts.
Do the apps not do that anyway, Alan? Do they not suggest stuff for you anyway, based on what you listen to?
What, little
do you
clips
know when
and
you
hit
browse? Well, I use the Apple thing, which I know you guys don't. But when I hit browse, it kind of gives me.
Thing.
Yeah.
But can you search for a subject if you want to talk about business building or productivity or fitness or
the
whatever?
search is not that great on Apple, but it's all right.
And it will extract the actual clip for you. And
that's decent. This overlaps.
Okay,
sounds good.
Yeah, check it out. It is good. You're welcome. Now I'm ready. I'll have to leave soon, but carry on.
Quick, let's go.
Okay. So, Alan, you recommended a book a few episodes ago, The Price of Tomorrow, which I read. And I have to say, I didn't think much of it, to be honest with you. Disappointed. And the second half was like a psychology book. It had no connection to the first. I thought at one stage I'd switch books on Kindle. So thank you, but no thanks for that one. But did you recommend Secret Tradecraft of Elite Advisors? Was that from you?
I did, yes.
I am enjoying that. I'm enjoying that.
It wasn't on this, was it? I read that on holiday. I think I sent it
who's
in our
by,
group chat.
David C. Baker. I can't remember, fellow. David
C. Baker. He writes a lot of stuff. He's good. Got a good blog.
Yeah, and he's very easy.
He reminds me of you, actually, Nick.
Well, I was going to say he's got a Brett. I was about to say he's got a Brett Davidson kind of a. He's an American guy, but he's got a Brett. He's quite direct, but it's all about how you make yourself a trusted advisor. The sort of traits you need to embody. The fact that it's not easy and it can be a hard slug, and you've got to be true to yourself. I've only about a third of the way through it, if that actually. So I'm liking it. I'm liking that a lot.
You'll enjoy the rest of it. So
okay, thank you. Well, I'll come back with a full review.
Is it quite short? It's only 3 hours on Audible.
Yeah. I'm getting through it quickly. But my book recommendation is, and this has nothing to do with financial services, but you know what? Even this cultural wasteland that you listen to and see in front of you if you're watching on YouTube, even this cultural wasteland does have some sort of hinterland. Set the Night on Fire by Robbie Krieger. He was the guitarist in The Doors, a band that kind of get overlooked sometimes because of all the hype around Jim Morrison and the drugs and the running with the law. But it's a really good book about a really, really good band. The Doors music is brilliant, and if you like your rock and roll, Set the Night on Fire by Robbie Krieger. Good read. Right, next.
My recommendation is Diary of a CEO, Mark Randolph, who's the founder of Netflix. If you're into business stories, getting sort of early business off the ground, it's amazing. I can't tell you how good it is. Brilliant. He set it up with Reed Hastings, is it? The other founder of Netflix, and the stories around Blockbuster being involved, Amazon wanted to buy them, but just also starting any business and getting proof of concept as quick as possible. It's absolutely brilliant. I can't recommend it enough. Check it out if you're early in your business career or into business stories. That's it. Over to you, Carl.
Great stuff. Thank you.
The Human Side of Money, Brendan Fraser interviews Michael Kitces. It's interesting because we're used to hearing Michael Kitces interviewing other people, but actually this one is Brendan interviewing Michael. There's Andy, I think you love it because he kind of goes through his background and how he ended up where he is, but he's lots of different brands going on, and he's a force of nature for sure. Yeah. And then as it goes through, there's some good stuff about reframing questions or reframing points to make to clients, and one of the big things he was saying is, clients don't give a crap about the behavior gap, and if you sell that's your proposition, you're not talking to what the clients want. So, we'd often talk about giving the clients, what's the phrase Alan you use? Give them what they
peace of mind,
want and
show them what they need.
I don't know. Yeah, exactly. We got there eventually.
Well, you've got to give them. Yeah, you've got to bring them towards what they need, but they don't necessarily know that's what they need.
That was the main. That's the main premise of kind of the second part of it. So it's really, really, really good, and an honourable mention for the Sky documentary King of the Metaverse. If, like me, you're getting a little bit concerned about Zuckerbergs and Musks of this world and how they're controlling our lives and everything that goes on, have a look at it. I think it'll freak you out. That's me.
Excellent. Well, chaps, somehow running on fumes, running on empty tanks. Well, three of us certainly. One of us. I can't talk for you, so that's not fair. Me. We are at 1 hour 17 minutes in, which by math you take 60, put that in the tens unit. 77 minutes in. I think that's a wrap for this show, gentlemen. Episode 53 has been flushed down the crapper. Thank you, dear Trappists, for your precious time and input onto the show. Please leave a review on iTunes, 6 out of 5 stars, or on Pocket Cast now. That'd be great. And like and subscribe to our YouTube channel. 894 people are out there watching us. It's unbelievable. I can't believe it. It can't be true, but I trust it. So until the next time, Trap Pack, from us, Andrew.
Yeah,
classic.
Just a quick shout out. By the time this comes out, the following show, I'll be in South Africa with Humans Under Management. So if you're listening to this in South Africa and you're a Trappist, I will see you soon. That's it, Nick. Over to you to close out.
Okay, I have just about finished. Until the next time, Trap Pack, it's adios from us and take care out there. Thank you for your precious time. Goodbye. Get the hell out of my computer.